Good evening, everybody. Hope everybody's having a nice fall evening. Tonight we've got the great pleasure of having Erik Wilkinson giving his presentation, and which is very viable because Erik's been a floor trader on the Chicago floor. So he's got some insights on what makes prices move and how to use that to your advantage. So with that, Erik, welcome to the Candlestick Forum. We're very interested in seeing your information tonight.
Thank you. First off, I'd like to thank the Candlestick Forum for inviting me in tonight. And Mr. Bigelow, thank you again for having me here with your group. A couple of things. This is Floor Trader Hacks. This basically is about 20 plus years of stuff that I've learned on the floor of the Chicago Board of Trade. I started out actually trading in college with a psychology degree and switched it over to finance, then moved to Chicago to work at the Board of Trade and started trading with my own money and have been trading my own money ever since. And in that time, traded everything from stocks, commodities, financial futures, currencies, and options on all those products in basically all market conditions. Got to go over a real quick disclaimer here. This is basically any opinions, news, research, and analysis or other information provided here by Pro Trader Strategies, associate companies, employees. Does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically what this is saying, you guys, is I don't know your risk parameters. I don't know what's in your portfolio. So therefore, what I'm talking about could exceed your risk parameters or be counterintuitive to what you're already doing. So keep in mind that past performance of any trading system or methodology is not necessarily indicative of future results. One thing you can do is follow us on Twitter. You can follow me personally at Wolfman's blog or follow Pro Trader Strategies at Pro Trader Strat. Appreciate seeing you guys all there. Anyway, this is Floor Trader Hacks for options in particular. There's a lot of different types of hacks out there, but as an option trader or even as a floor trader, one of the things that we had to do on a daily basis was come up with the math really fast on all of the nuances dealing with options. And as many of you guys may know, there's a lot of things going on in these options. So the first person to come up with a quote or be the quickest to it was the person that usually got that trade. So these things still overlap into today's world where we're trading online because there's so many stocks and ETFs and different types of things to trade that these will speed up your process on a daily basis and help you really understand some of the nuances within those options chains. So first off, the most important thing as an options trader, and these were things that, like, on the floor as traders, we would meet an hour before we opened and even an hour after we closed at some point in time, just talking about implied volatility or volatility in general and how that was affecting our premiums. So this is going to be one of the most important things as an options trader, and if you are already an options trader, you know implied volatility is top of mind. Well, one of the things to know about IV percent is how to come up with that math. And it's basically the current IV minus the low IV over the past 52 weeks. And you divide that sum by the sum of the high IV minus the low IV. Now, in that, for instance, with gap here, this is the IV at the very bottom, this little blue chart. I don't think you guys can probably see my cursor, but basically right down here is where the IV is. And as you can see, over the course of the year, it varies quite dramatically. Usually at earnings, it spikes. But I want you to notice right here at this spike right there, it was on a dividend. So that's a real outlier move. Now, one thing that's going to happen throughout the course of the year until that one data point goes off is it's going to kind of skew what our numbers are because that is a big outlier. Now, one thing that we used to do on the floor was kind of discount that particular number. So before we go into this, the IV%, using that math problem that I showed you guys before right here, this would give us 41% right around there. Now, what's important with that? Well, some of my webinars I go into detail of this, but it's really a determining factor as to whether or not we're going to be selling options or buying options, and I go into that in some of my webinars and don't have enough time to really go through that now. But if we discount that one spike and we do the math based on this spike here, which is pretty close to the rest of them, and those spikes are coming in during earnings, which is when we would really expect to see volatility expand. If we discount that one particular one, our math comes up with a result of 53.8. And along my rules, I don't sell options unless IV% is above 50. So that is a little hack in order to figure out what the real number is, because in my eyes, when you have a massive outlier, that really doesn't come into play maybe for another 2 or 3 years. So it's really should be discounted as a data point. So if we took the current IV, which it would be where this line is, 44, right over here where the arrow is, that's 44 where the current IV is right here. And we subtract that by the 30, which is the low. That's about a 30 there. And then subtract it by the new 56, which is the high we have come up with right here where that line is across. That's around 56 minus 30. That's what gives us a IV% of 53.8. Now, what does that mean? It just means that right now we are in the upper half of where volatility has been in the past. So that's important in trading options. You don't want to be buying options when IV% is above 50, because you could be directionally right and still not make money. Has anybody ever had that issue where they bought an option, you got the directionality right, and all of a sudden you're losing money? And usually that's because what we know of is theta, but volatility will hold up theta from decaying that underlying, and when volatility comes out, all of that theta comes out at one point in time. Now, on to another one. Now, delta, this is just a basic definition of delta, and this is what, as options 101 goes. Delta is the amount an option price increases or decreases for every dollar move in the underlying. Now, that means if ABC stock goes up by $1 and your delta is a 35 delta, let's say, that option price will only go up by 35 cents for every dollar the underlying moves. So the option doesn't move up lockstep with the underlying. But what the delta hack is delta is the probability of our option being in the money at expiration. So that's by 1 penny. That's the probabilities it will be in the money by 1 penny at expiration. So if it's an in the money option, you'll see those deltas be anywhere from 50 to 99. That means the 99 delta has a 99% probability of being in the money at expiration by at least 1 penny. Now, if you look at the ones that are out of the money, those are also telling you what the probabilities of that underlying being in the money or that strike being in the money at expiration. So if it's a 16 delta, it's telling you that the probabilities in the next several days is that it will be in the money by 1 penny. So I thought I may have missed a, we'll go into that a little bit more when I have a different slide. All right, then we need to understand what the delta and standard deviation relationship is. Now, this is the way to come up with standard deviation, and I told you guys this was going to be hacks, and I know a lot of your people, a lot of you guys out there are thinking, oh my gosh, and believe it or not, the slideshow I had was going to make this explode while it played, but it didn't work out that way. But I'm not going to have you guys really memorize this just to know what standard deviation is, and that's kind of crazy. You can imagine trying to punch this into your computer and figuring out what a standard deviation is. That's not what we're going to go into. If we look at a regular bell graph here. These are the standard deviation. This is a 1 standard deviation, a 1.5 standard deviation here, a 2 standard deviation, a 2.5 standard deviation, a 3 standard deviation. What does that tell us? This is telling us that in order to get all the way out here to, say, the 2 standard deviation move, that is a very rare occurrence. We can add up 1.7 plus 0.5 or 0.5 and 0.1, and that gives us around 2.3%. So only 2.3% of the time will an underlying be in this range at expiration. So that's important for us, and I'll go into that in a little bit more detail here soon. But the same goes for this. This is telling us what the percent probability is of an underlying trading out to these extremes over the course of the trading regimen. And this is the hack for that standard deviation move. And this is something you guys can throw down on a piece of paper and start writing down. Sorry, I started missing some of them. A 2 standard deviation move is a 2 delta. A 1.5 standard deviation move is a 7 delta. A 1 standard deviation move is a 16 delta, and a half standard deviation move is the 13 delta, and that's the correlation on probabilities. So we just talked about this a little bit before, and this is what we're going to use when we're starting to trade, are these different okay, on the internet, sorry, some people think the audio may be breaking out. Yeah, imagine your head explodes when you did the math on that one. That's what I was trying to do, but it didn't work out the way I wanted to. Sorry about that. So getting into this a little bit further, all of these things come together. So the delta, remember, we're talking about probabilities. A 2 standard deviation is a 2 delta. So the chances of an underlying trading to the 2 delta is 2% of the time. So 98% of the time that 2 delta option strike will be out of the money. And then the same goes for the rest of them. A half standard deviation is a 31 delta, meaning that 69% of the time it's going to remain out of the money. So this is what we're talking about, is when we're looking at an options chain here, we're looking at these, I hope you guys can all see them, they're pretty small on my screen, but going into it, you know, the 2 delta right here on the 812.5 strike, you know, it's a 3 delta, so you can still do the math that way. 3% of the time it's going to be in the money, but 97% of the time it will not be in the money. And if we go to this 15 delta, which is really close to the strike that we were looking at, 15-16 delta, that means only 15% of the time this strike will be in there. So we're playing probabilities, you guys. I don't know if you guys played much cards or anything along those lines, but it's kind of like you're playing the probabilities here. If you know that you can consistently keep this out of the money and you know your probabilities of being in the money, it kind of keeps your powder dry when you're trading these, all right? So always think about it, probabilities. The probabilities are the probabilities, and the probabilities will work out. Paul, you need a little lost here. You need the big picture. The big picture is creating probabilities of success. Like if you're playing cards and you've got pocket aces and you're going up against, or sorry, pocket eights, let's say, and you're going up against aces. Well, if your chances of winning are 4 to 1, but the pot is paying out 6 to 1, you'll probably do that all day long, because all of a sudden you've rolled the probabilities into your favor. You have the higher probability of success against a pot that's paying you out more than what your hand is giving you. So in this, if I'm going to sell this strike, that's the 15 strike, right? And I do this consistently over time, the probabilities of me being out of the money will come through. And 85% of the time, I'm going to be out of the money on this. So I will be able to collect the entire premium. And if you're an option buyer, you know, and you wanted to go closer to the money, if you're going to be buying this option, you know that 51% of the time, it's a 50-50 shot for the most part. So it's actually slightly better, 50% of the time is slightly better than just going out and blindly buying an underlying. Now with Steve Bigelow's charting, you guys will be able to use this in order to figure out what your probabilities of success are. When he comes up with say a bullish call, then you'll know which strikes you're going to want to buy. Like you would want to buy a higher probability strike in order to make sure that you are going to be in the money. But you know, depending on volatility, and I go into that, it's going to depend on whether you buy or sell that underlying. So if it was a high volatility in the market and it was giving you a buy signal, then you would probably go over to the puts and sell like a 16 delta put or a 20 delta put in order to know that your probabilities of being out of the money are in your favor and you got the direction going your way. That would be the indication as to whether you were going to be buying or selling those. Does that make sense? Yeah, this is probably Amazon. I think it was Amazon or something like that. I just took it off so it wouldn't be too confusing. I wanted to fit in that lower delta, like the 2 delta here, but I couldn't get the 2 delta here. Does that make sense, you guys? Okay, good. All right, so also, here's another hack that Delta tells us. They're giving you 3 hacks for Delta. Delta is the probability of being in the money at expiration by 1 penny, and Delta is the number of shares you're hedging. Now, a lot of people, this is a little counterintuitive, but if you buy 100 shares of XYZ and you sell a 16 Delta strike or call, then keep that in mind that for every dollar the underlying goes up, your premium goes up by 16 cents. So you're kind of losing 16 cents on your call, but you only have a 16% probability of it being in the money. So you might be able to collect that whole credit, right? Now the idea, a lot of people don't like to hedge, do covered calls because they're like, well, what if it continues to go through that strike? Well, there's this option is never going to increase more than the underlying goes up. So if we sold these 16 delta calls in Tesla, probabilities we talked about, there's an 85% probability of this being out of the money. Only a 15% probability of it being in the money. But remember, we're going to continue to make money on this underlying if it goes up. Even as you can see, these ones that are in the money, even for every dollar move up in the underlying, we're only losing, 90 cents, and that's deep in the money. I mean, that, those are successful trader problems, right? I mean, if you've sold a 16 delta call and all of a sudden it's gone that deep in the money, you've done well because you've outpaced on the upside. You still made a lot more money than you lost on the call. But keep in mind, 85% of the time you are going to be able to collect the full premium. So we're lowering our cost basis. So, we're going to continue to pay less, in a sense, for that underlying we bought. So if we bought Tesla at, 223, if we continue to do this over time and keep collecting that dollar month after month after month, sure, every once in a while it is going to go against us. We're still participating on the upside, but this will still be a profitable trade. Also, this is something, you guys, that this is a serious floor trader hack too. This is something we always use to determine our risk. One thing is determining your risk probability of being in the money. But during the lifetime of a trade, during that, let's say, 30 days that we're in this trade, the probability of that strike being tested is 2 times the delta. So if it's a 15 delta, keep in mind that the strike has a high probability, or the underlying has a high probability of coming up and testing that strike that we're short. But over the duration, as the market goes up and down, we all know the market goes up and then down and up and down. Keep in mind that that's during that 30 some odd days, and once it goes back below, we've collected that whole entire credit. So the probability of being tested, and this is a huge one, nobody even talks about this online or anywhere else. This was something we did all the time, is to keep that in mind, to keep your powder dry, to stay in the trade, that the probabilities of being tested are 2 times the delta. Can I make it the full screen size? Maybe if I do that, does that work? Then I can't read anybody's stuff. All right, so for instance, just for an example, I know it's small for you guys, but the 15 delta here on Tesla, we're looking at it as a cross to the 240 strike. The probability in the next 20 odd days is going to be 30% chance that Tesla will go up there and at least touch 240. Okay, and when you're talking with Stephen on his charting and stuff like that, and you get a buy signal, you can figure out where you need to be buying an option or selling an option based on probabilities. If you want it to be out of the money and you have a target there or a support resistance, you're going to use these probabilities to know exactly what your likelihood of success is if it goes against you. And yeah, I'm being asked, will this work with weeklies? Absolutely. Delta is all about probabilities. So Statton's asking, if I buy the 40 delta, there's an 80% chance it will go into the money at least once. Well, there's an 80% chance that it will touch that strike, so it will be at the money, let's say. Yes, you are correct. 80%, 40 delta means there's an 80% probability it will at least touch you. Okay? I can't deal with the rare audio cutting in and out. Well, you guys will get a recording. They're saying that the recording will actually be clear. So how do I use implied volatility with this? Anytime implied volatility is above 50, then we'll be selling options. And I like to sell the 15 delta option because the probabilities work out the best in my trading. That's what it seems to work out the best. So so that's what I'm very comfortable with. I like collecting that dollar. And the reason why we want high implied volatility to sell these options like the 15 delta, then when implied volatility comes down, you see that decay in those options much faster. And I'm not one to hold on to this all the way into expiration. I don't go for that whole dollar. I'm usually going for 50% of that dollar. And that's something I go into a lot more detail in my webinars that I'll talk about in a little bit. All right, so the expected move. Now this is another really important thing. This kind of goes along with the delta, but maybe you're looking at a price target and you want to know what the expected move that these options are telling you. Well, here's the math, and if you want to do the square root, you can do all of that, but that's something, again, I don't think you need to remember. One thing you can look at on TOS is here's the expected move up here. But the idea here with the expected move, to figure it out very quickly, is to basically go in to the options chain again, and you can look at several different things with that other, you got 25 days to expiration divided by 365, take the square root of that. Anybody got that off the top of their head? This math isn't easy to do in your head. So let's go on to something else. Another thing that you can look at up here at the top is a lot of, during earnings, they'll give you the expected move up here, and that's also a ballpark. That's for the 1 day, it's the expected move to the end of the cycle. But we're not, in my trading and what I teach, we're not going to the end of the last day. The probabilities don't work out nearly as well as taking 50% of your profit as far as I'm concerned. So here's the hack. So if we're going to be looking at one day, staying in this trade for one day, you don't really need to know that formula. It's basically the stock price times the sum of implied volatility divided by 100 times the square root of days to expiration over 365. That's the formula. But we don't need to know that because we have this. And this is another sticky note thing where you can just write it down and easily punch this in. The expected move as a percent is you take what the current IV is, which in that one case that we showed of gap, it was 44. Here, I'll go to the gap. Remember, this is where the current is. This is showing where the current IV is. So on a chart, you can find it in just about every single trading platform there is look for IV percent and or current IV, and then you can do the math from there because we talked about this math problem here. But the current IV is 44. So we would take that current IV 44 times the 19, right? And that will give us what our expected move for the underlying is in percentage form. So then, you know, you would need to go back and multiply that percent times the stock price to get it. But we just want to know percents because I want to know what the underlying is expected to move in percentage terms, just to make it easier to do the math in your head. These are all really ballpark, you know, the expected move that I talked about with that last formula, with the stock price divided by, or times the square root of the days to expiration, yada, yada, yada. That's going to be a little bit more granular, but you got to remember all of the applied volatilities and everything else is pretty much an estimate. So, you know, you're doing an estimate of an estimate. So whether or not that is closer to target to this is debatable. And keep in mind that with these hacks, we're trying to overstate some of this stuff in our own minds so that reality is inside of that, is what we're trying to do with this. So the current IV for one day is divided by 19.1. If you wanted to get it 1 week out, you take that current IV and divide it by 7.22, and this is going to give you the percent move expected in that underlying, or the current IV divided by 3.5. And keep in mind, when we're looking at IV, high IVs, that is overstated, and usually low IV is understated. So that's how we kind of play those, and I go into more detail with that also in my webinars. But this will give you a quick and fast assumption as to what the expected move is. So again, back to Mr. Bigelow's candlestick charting, you could use what the IV is telling you, and if you're getting a buy signal or sell signal, you could implement this into your strategy to figure out where that underlying is going to move, expected to move to, because it's in either direction as well. So if you're getting a sell signal, then you could do this expected move, and that will give you what the market is expecting the move to be within a day, a week, or the month. Okay? This is divided by, so the current IV divided by 3.5. Okay? So yeah, I mean, I see a lot of people saying they didn't realize about the standard deviation move. I tell you, there's a lot of things that people don't really teach, you know, online or anything else. These are some of the things that we looked at on a daily basis when we would look at we used to have sheets on the floor. If you ever would look at the floor traders, you know, they'd have like mounds of paper folded up long ways, and we would flip through that, and that was how we would quickly determine what our probabilities were by using the delta and how we needed to hedge something. If somebody stuffed you with 100 contracts, you needed to know how much you needed to hedge that with, because we weren't always selling just one contract for every 100. We might have been selling like 3 or 4 of the out of money deltas in order to equal that 100 of the underlying, so they would offset to really create a perfect hedge. All right, so that's back to the chart just to show you where the current IV is. Now on to the next one, and I'm starting to run a little long in the tooth here, so I'm going to try and pick this up. This is great for earnings, you guys. So you take the at-the-money straddle times 0.85. So if you're looking at underlying for an earnings trade, the expected move for BBY, which is Best Buy, we take the at-the-money straddle, right? So a straddle is selling both or buying both. It doesn't matter which way you come up with the answer, as long as you're selling both and buying both. But if you looked at this and we pulled it up, where I'll just give you the numbers on this. So if we took the at-the-money straddle, which is 122, so we'll take this strike, the calls that are just slightly out of the money, because those are the ones that are closest to. You can see the 32, the closest to where the underlying is trading. We take $1.22, add on the 92 cents for the puts. So we're kind of going mid-price there. We add those two together and multiply it by 0.85, and trust me, we get a total of, our number comes out to be 1 point, you get a dot there, 819. So the expected move overnight for Best Buy for this underlying is $1.82, let's say. And right here, they give it $1.82.4 or something like that. Not everybody platform gives you what the market maker move is, but that's how you figure it out. A lot of times if there's more days to expiration over here than just 4, this number could be a little bit higher. But we're looking for the 1-day expected move, and this is the quickest way to get to the 1-day expected move. It's the at-the-money straddle times 0.85 for that one. All right, and really quickly, this is an easy one. If you're doing pairs trades and you're trying to offset, you know, your risk in your portfolio, if you had 2 stocks that were highly correlated, one stock's and I'm going to give you easy math. One stock is trading for 100 and another stock is trading for 50. You take the stock price of A, which is always the higher price stock. So this would be the $100 stock. Divide that by 50. It gives you 2. Right, so it means that you need to buy 2 of stock B for every 1 of stock A. I mean, that's pretty basic. So I made that really easy. But again, when you're trying to figure out stocks where it's Priceline and Google or something like that, those numbers aren't going to be exactly like that. But that's how you get that granular number in order to determine how many of stock B you need to buy for every 100 of stock A you buy. Does that make sense there? That one's a pretty easy concept, but a lot of people don't really realize that. All right, so also, you know, I don't have enough time. I'm running out of time. I got more hacks on the volatility crush, how you can like really determine how hard volatility is going to crush over, you know, the next year for that matter. You can see what volatility is going to crush to, and I've got some other little quick math things that you can do for volatility crush, which is really important. Also, expected moves in accounting for SKEW, because basically sometimes when things get wanky, the puts get more premium put into them, and that creates SKEW in that bell curve. So the bell curve might actually not look like that, but it could look more up and then down like that. So that's SKEW, and I talk about that. How much intrinsic value there is embedded in the money option. So it's a real quick way. Some people go through, do the math, you know, the strike minus the premium equals where the underlying minus the underlying. Well, I've got it where you can just flip back and forth, and it's simple. You don't even have to know what the strike is or the underlying is trading at. Also, you can also determine what the market is expecting you how a hack on figuring out what that stock's dividend is going to be well in advance of a dividend announcement. All right, does anybody else have any other questions real quick? I knew I blew through that pretty fast. Had a lot of information to go over. Erik, you're saying that GPS example, that the expected 1 week move was 6.09%. Yes, 6.09%. And then you know, if you wanted to figure out what that equates to in dollars term, you would do 0.06 times what that underlying is, and it would give you the dollar. Okay. Good way to use delta. Yes, thank you. So basically, for everybody participating in this, I know a lot of people don't have, you know, even if you guys have learned just a little bit from this webinar or this little example here, you know, even savvy traders learn something new every single day. And basically for this price, $36, this is unbelievable. I was pretty shocked when they threw this out there. But, you know, even people that have traded a long time, this is really great trading knowledge for anyone. It may seem somewhat basic, but, you know, I talk about things that not everybody is talking about when we're talking about trading options and options terminology. I talk about it from a floor trader standpoint. So if you've enjoyed my hacks and learned something new, even if you're a savvy trader, like I said, this is a fantastic price. And there should be a link in your chat box there. You can just click on that. It'll take you straight to this. And even if you're a newer trader, you're going to learn something from these for sure. And for $36, you know, that's basically, you know, what you're risking on a one lot or making a small trade. So that's invaluable. And these techniques are designed to help produce consistent winners. You know, I'm talking about probabilities and things like that. You know, you play the probabilities, you will consistently do well over the course of your trading time. Sorry. Do you show how to set up the option screen on TOS? Yeah, I use TOS, so I show how to set it up the way I trade on TOS. I also show how to set it up, you know, even with my charts and things of that nature. So, and you know, at $36, you guys, this course is going to pay for itself many times over. One other thing that's not mentioned on here, if you guys sign up for this course, you get unlimited access to me. I know Mr. Bigelow does the same thing where, you know, you guys have access to this room, which is absolutely amazing. You have access to me as well, where you can reach out to me at trading@protraderstrategies.com. Also, with this course, you get my daily market commentaries where I talk about every trade that I've done, every trade that I get out of. I talk to you about the trades that go bad and go against me and how I'm managing those trades, and literally lockstep go through every single trade that I'm doing. You know, whether or not you guys take those trades on yourself is, like I said, up to you guys, because I don't know if it's appropriate. But like I said, even savvy traders will take something away here. Oh, and this is also super important. You know, the Fed's going to start raising rates. How to protect your portfolio against rising interest rates and using options to do that. You guys don't realize every time that I go into detail as to how much money you're losing on those bonds as interest rates start going up. The average person doesn't hold bonds for 30 years. They hold them for 7 years. So in that 7 years, you could really get decimated if you're not being mechanical and hedging those bonds in your portfolio. All right, that's about all I got for you guys. If there's not any other questions really, please reach out to us at 310-598-6677, or like I said, you can always reach me at trading@protraderstrategies.com. Cheap like borscht. Yes, absolutely. And it is all learn at your own pace, absolutely. And like I said, if you have any questions, you can reach out to me anytime. I have a no inbox policy on my email, so anybody who reaches out to me, then I will reach back out. Jim's a cheapskate and he just ordered this deal. Thanks, Jim. Appreciate it. So you set your price targets? Absolutely. I talk about all of that stuff constantly. I'm probably not as good of a candlestick reader as Mr. Bigelow, but I'll probably stick around and listen to his presentation too. So, all right, guys, thank you very much. If you can't take that, take it easy. Yeah, the website's right there at ProTrader Strategies, or ProTraderStrategies.com.
Thank you very much, Erik. Good stuff.
Thank you.
And again, everybody,
Thank you
this
very
is the
much.
type of information that you're getting it right from a floor trader with experience. So these are little tidbits that any piece of this could help you with your trading from years to come. So with that, Erik, like the stuff, get his package, skip 3 or 4 sessions at Starbucks, and learn something you'll probably use for the rest of your life. So with that, everybody, have a good evening. We'll see you bright and early in the chat rooms.